Three things to check to make sure that the stock that you're buying doesn't go bankrupt. Now, in the previous video, I talked about the income statement where we were discussing the financial performance of the company, right? So, because the income statement, that's what the purpose of the income statement is, to let the stakeholders, specifically the investors, know how the company is performing or has performed over a specific time period, right? So now, in this video, I'm going to talk about the balance sheet, which is, of course, one of the three major financial statements, and why it's critical for investors to look at this specific financial statement, that is the balance sheet, before making an investment. So very quickly, I'll just tell you the format of the income statement. That is what it includes. The balance sheet is basically the basic format, the basic structure of the balance sheet is that assets equal to liabilities plus equity. Okay, assets equals to liabilities plus equity. Assets are whatever the company owns. Okay, this could include long-term assets and short-term assets, right? And then there is liabilities. Okay. Liabilities would include, again, short-term liabilities and long-term liabilities. Liabilities, in very simple terms, is what the business owes to others, okay, to creditors. And then finally, there's equity. Okay, equity is basically what's left over for the shareholders once the creditors have been paid off, right? In other words, if I sell off all the assets, right, and with that cash, I will first, of course, have to pay the creditors, right, or the lenders, and then if anything is left over, or whatever is left over, will belong to the owners or shareholders of the equity, or shareholders of the company. And that is basically whatever is left over for the shareholders is called equity. Okay. Now, please remember that the basic structure, the format, or the basic equation of the balance sheet is that assets equals to liabilities plus equity. The way to understand this specific statement, this specific equation, is that all the assets that the company owns, it's going to be either financed by, which is the money. Where did the money come to buy those assets? The money will come from either creditors, that is, the company is going to borrow the money to buy those assets, or it will come from the owners or shareholders of the shareholders of the company, right? So money to buy the assets which is coming from the shareholders is called equity, and money which is coming to buy the assets or acquire the assets from the creditors or lenders is called liabilities. Okay, that's basically, now you understand the basic structure of the balance sheet. Now, what are the things? Now we'll come to the three things which I look at when I'm evaluating or when I'm analyzing a company's balance sheet, right? So, and please remember that different analysts will look at different things. They might have slightly different perspective, but this is the other things which I find to be, after analyzing, studying and investing for almost 20 years now, these are the things which I think are very important on the balance sheet to look at, right? Now, the first of these is basically how much cash does the company have on its balance sheet, right? And this can simply be seen as cash and other short-term investments, right? These two are basically the cash is, of course, the most liquid asset on the. It is liquid, right? It is cash, so it's highly liquid, and short-term liabilities, of course, short-term assets, like especially short-term securities, are also quite liquid, right? So these two. This number I like to look at because it tells me how much, it basically reduces the chance. If the company has a lot of cash on its hand or on its books, that means that the chance of the company going bankrupt is low. Why? Because, of course, if once the liabilities come due, because bankruptcy is when liabilities come due and you are unable to pay, right? That's basically when there is a chance the company can go bankrupt. So the more cash the company has, the lower the chance of the company going bankrupt, right? So, but please remember, there needs to be a balance. It does not mean that the company having too much cash is also a problem, because that means that the company is not allocating resources efficiently, right? Because remember, cash is relatively going to earn very little to no return, right? And basically, we want there to be a balance between the two, right? Not too little cash, because that increases the chance of bankruptcy, and not too much cash, because that leads to financial inefficiencies. Now, that's basically the thing with cash and cash, right? Now, when I look at the cash, I'm going to compare it against at least my current liabilities, right? So current liabilities, so for example, if I have a 1-to-1 ratio, that is, if I take the cash and divide by the current liabilities, if I get a 1-to-1 ratio, that means that the company, for every $1 in liability, the company has $1 in cash. Okay, that's pretty safe, right? In my not to get too detailed with it, right? Because there are certain nuances, but keeping things very simple for now, that's very safe. Even 0.6 or 7 is, I personally, depending on the different industries, but again, if I go into that, it will take too much time. So just keeping things simple, I like to see a ratio, cash to short-term liabilities ratio of 0.7 to 1, right? Now, so that's basically the first thing I look at on the balance sheet. Another thing I like to look at is the total long-term debt. Okay, how much debt does the company have? Okay, and different analysts like to evaluate this in their different ways. I personally like to see the company having not more than the company being able to cover that long-term debt in 2 to 3 years, right? In other words, if a company has, let's say, $6 million, is company making, let's say, around $2 million in profits, right? Then I mean, the way I analyze this is that the company should have not more than maybe maybe $4 to $6 million in long-term debt, right? So basically, if it has $6 million worth of debt and the company is making $2 million in profits, then about 3 years the company can pay off that debt with the profits, right? Now, even if you want to be even more stringent with your analysis or with your evaluation, or you want to set even more tight criteria, you can basically have it. You can, instead of taking profits, you can take free cash flow, right? Because remember, there's a difference between profits and cash. Okay, cash flow. Right? Not to get into too much detail over here, but yeah. So, and by the way, free cash flow is basically what is basically the cash that the company will take home, or the owners of the company can take home after taking into consideration the capital expenditures, right? Maintenance capital expenditures. But again, that's getting a little more complicated. So let's keep things simple, right? So you guys can just look at the profits, right? Now, that's the second thing. And then the third is working capital. Of course, working capital is very important, because working capital is the lifeblood of any business. It's basically what keeps the business running, right? Remember, right? So, because working capital is basically things like, is basically things include things like current assets and current liabilities, right? Is basically, where is the money coming from? In very simple terms, I don't get too complicated with working capital right now, but very simply, where does the company have enough resources, right, to keep the day-to-day operations of the business running, right? So what I'll do is you can calculate by taking your current assets minus current liabilities, right? That will give you your working capital. And so my criteria for working capital is that I like to see a current ratio, right? So current ratio, by the way, is basically current assets divided by current liabilities, right? So for example, if you calculate the current ratio of the company and you get 2, that means a ratio of 2 to 1, which this means that for every $1 in current liabilities, the company has $2 in current assets, which is good, right? The higher the number, the better. But again, remember, too high of having too much working capital can also lead to inefficiencies, right? It means that the company has too much in assets, right? And remember that some companies, this is a technical detail, or it might be a final nuance, but just to give you guys a heads up, that normally most analysts, most companies with negative working capital it's considered to be a red flag. But sometimes some companies are so efficient with their working capital management that negative numbers might be a positive thing, right? But that's beyond the scope of this video. For now, for the scope of this video, I would just say that if the company has too little of working capital, then that's a red flag. You wanna avoid that company, because the chances are high that the company is going to might get into trouble because of insufficient working capital, right? So that's basically the three things that I look at on the balance sheet. In the next video, we're going to take a look at the cash flow statement and see how how to analyze that specific statement, right? So in the next video, we would have covered all the three financial statements. That is, in the last video, I covered the income statement. In this video, I covered the balance sheet. And the next one, I'm going to cover the cash flow statement. I hope you guys found this video to be helpful. I'll see you guys in the next one. Take care. Bye for now.